I'm Tolga Necar, and this is Erik Vilaca. We're here from the Property Consulting Division at CACI. Now, over the coming weeks, we're going to be looking at how the cost of living increases are impacting and influencing the residential market, looking across both for private sale and the rental market across all regions. However, in this first instance, we're going to focus in on that inner London market, which is such a bellwether for the wider trends.
Okay, so Tolga, we already know that 42% of net disposable income in London is already spent on rent. In the context of the rising cost of living, what do you see the impact being on the rental sector in London?
So we're already starting to see that come through in pretty stark numbers. The latest figures from 20CI show that inner London private rental prices have increased by over 20% year on year. Now, that's off the back of some trends that we saw coming out of the 2021 market, where an inflow of consumers meant that actually people were able to sweep up pretty good deals. However, we're now annualizing on that. And so overall, if we look at the versus pre-2019, pre-COVID numbers, the average rent agreed is 10% higher than it was.
I mean, look, 20%, 10%, these are big numbers. What does that mean in pounds and pence terms?
So pounds and pence to the consumer, we're looking at about £240 more per month in Q2 2022 compared with the pre-COVID view. On a year-on-year basis, that's over £500 of increase in private rent.
So these are obviously significant increases. Bearing in mind the different segments that we track, are we seeing any difference between how they're now behaving with regards to the rental market?
Yeah, so I think it's really important to acknowledge the different drivers of different groups. So within London, we have quite a polarised population. We have some lower affluence groups who've typically been driven by more functional needs and requirements. They cite things like familiarity with an area as a key consideration for them, proximity to their friends and family, the suitability of the area for their kids, how safe the area is, and of course really chiefly affordability within that. So those groups are less mobile. Because of those factors, they're more tied to a location and less able to up sticks and move. When we think about the more affluent groups, they are very mobile, and they've historically chosen locations on the basis of the vibrancy and the fun that they can have. So yes, proximity to work and connectivity is really important to them, but more than 50% of these people choose an area because it's got good pubs, bars and restaurants in it. They're engaged by the sports and leisure provision there. However, these are all areas that across the board, people are saying that they're actively going to cut back on as a result of the cost of living increases, which has real implications for not just the flats and units that people are thinking about, but the localities that they want to live in.
So I guess, would it be fair for me to summarise that movers, when they're having to move at this point in time, are having to make some pretty severe sacrifices, but at the same time, landlords, developers need to understand what the values are of these consumers, of these prospective customers, double down on the proposition and the value of the assets that they hold, particularly when it comes to these more valuable, more mobile, affluent segments that are often the biggest targets for them.
Yeah, absolutely. The other thing I'd just kind of throw into the mix with that is a recognition of the value of your current renters. So one way that people are mitigating those price rises is simply not moving. Volumes in the rental market is down year on year. And so for renters, for landlords that have good relationships with their renters, actually maintaining those individuals is going to be really important for them going forward too.